Hello, good day. Welcome to the first finance course in your undergraduate study. My name is Khan. I'm delighted to be your first finance lecturer at University of Reading, Malaysia. I think my responsibility is high to bring you through the journey of learning finance, to inspire and instill interest in your study. Hopefully, I hope this video will give you a good understanding about finance as a module at university level. The objective of this introductory video is to give you an understanding of what financial management is all about. What is finance? What is the role of financial manager in the corporation? What is the goal of financial management? Well, I hope at the end of this video, you will understand the meaning of finance, why we study finance, and how financial study can make a difference to your life perspectives. Finance is worth studying. Finance gives you an opportunity to work in a field where there is room for judgment, experience, and creativity if you know how to use the tool of modern finance. Stay tuned and let's learn together. What is finance? How do you define finance? Finance can be defined as the science and art of managing money. Financial management is concerned with the maintenance and creation of economic value or wealth. I'm sure it is interesting to learn about how to create wealth to fulfill our basic needs and ambitions in life. Financial management focuses on decision making with an eye toward creating wealth. At the personal level, finance is concerned with individual decisions about how much they spend, how much they save, and how to invest. In a business context, finance involves the same type of decisions: how firms raise money from investors, how firms invest money to earn a profit. The secret of success in financial management is to increase value. That is easy to say, but not very easy to do. Instructing the financial manager to increase value is like advising an investor in the stock market to buy low and sell high. The problem is how to do it. A good working knowledge of finance is essential for success in personal life and business. Learning the techniques of good financial analysis will not only help you make better financial decisions, but it will also help you understand the financial consequences of the important decisions, no matter what career path you follow. In business, everything from marketing to human services are related to financial issues. This makes it important for anyone who plans to work in business to learn the fundamentals of finance. The goal of the firm is to maximize its value and therefore the wealth of its shareholders. Maximizing the value of the firms means running the business in the interest of those who own it, the shareholders. Because shareholders are paid after stakeholders, it is generally necessary to satisfy the interests of other stakeholders to enrich shareholders. There are other possible financial goals, for example, to survive, to avoid financial distress and bankruptcy, to beat the competition, to maximize sales or market share, to minimize costs, to maximize profits, or to maintain steady earnings growth. Let's picture the firm's balance sheet in your mind for a moment. The financial manager's primary activities are making investment and financing decisions. Investment decisions determine what types of assets the firm holds. Financing decisions determine how the firm raises money to pay for the assets in which it invests. If you become a financial manager, your ability to adapt to change, to raise funds, to invest in assets, and to manage wisely will affect the success of your firm and ultimately the overall economy as well. Why is the investment decision important? The investment decision is important when it comes to value creation. Investment decision is the decision to acquire assets. The basic questions relating to investments are as follows. First, how much should the firm invest? It is about a determination of the total amount of assets needed to be held by the firm. Second, in which project should the firm invest? Fixed or current? Tangible or intangible? Real or financial? The composition of the assets must be decided. Most of these assets will be real assets employed within the business to produce goods or services to satisfy consumer demand. Real assets may be tangible. For example, land and buildings, plant and equipment, and stocks. Real assets may also be intangible. For example, patents, trademarks, and know-how. Sometimes, a firm may invest in financial assets. Such investment does not form part of trading activity and may be in the form of short-term securities and deposits. Investment decision is also known as capital budgeting. The capital budgeting is the process of planning and managing a firm's long-term investments. In capital budgeting, the financial manager tries to identify investment opportunities that are worth more to the firm than they cost to acquire. This means that the value of the cash flow generated by an asset exceeds the cost of that asset. Investment need not be purely internal. Acquisitions of other companies represent a form of external investments. Also, the flip side of investment, disinvestment, must not be ignored. Assets that can no longer be economically justified may need to be reduced, eliminated, or replaced. The financial manager's most important job is to make the firm's investment decisions. The financial manager may weigh the costs and benefits of all investments and decide which of them qualify as good uses of the money invested by the shareholders. These investment decisions fundamentally shape what the firm does and whether it will add value for its owners. In financing decision, the financial manager is concerned with the mix of financing and how best to physically acquire the needed funds. The capital structure is the mixture of debt and equity maintained by a firm. It is the ways in which the firm obtains and manages the long-term financing it needs to support its long-term investments. For example, issuing shares, raising loans, undertaking lease obligations, and etc. The financial manager must decide whether to raise more money from new and existing owners by selling more shares or to borrow more money. In addition, dividend policy must be viewed as an integral part of the firm's financing decision. The dividend payout ratio determines the amount of earnings that can be retained in the firm. Retaining a greater amount of current earning in the firm means fewer dollars will be available for current dividend payments. The value of the dividends paid to stockholders must therefore be balanced against the opportunity cost of retained earnings for future investments. Learning about finance is highly practical. To face the ever-changing and challenging business world, we can use the basic principles in finance that have brought us this far. Bradley highlights 5 themes that recur again and again. First, corporate finance is all about maximizing value. Second, the opportunity cost of capital sets the standard for investment decisions. Third, a safe dollar is worth more than a risky dollar. We are going to learn about time value of money. Fourth, smart investment decisions create more value than smart financing decisions. Going forward, we are going to learn about investment valuation. And lastly, good governance matters. I hope you have learned something from this video. See you and goodbye.